Good afternoon. It is 12 o'clock, February 3rd, but also good morning or good evening because we are recording this, so you may be listening to it at your leisure at another time. This is the second in the Lunch and Learn 2026 tax series. It is Tax 101. It is really intended as a basic primer of taxation in general and of the major provisions and interesting deductions or credits that you might want to know about. The series goes on every Tuesday at noon. We have it in English. At 1, I stay and repeat it in Spanish. So you can look on our Facebook page at LSNV, Legal Services of Northern Virginia, and there is the schedule. Very well. If you don't know, then you should know that there are different types of taxes that we have to pay depending upon our status as taxpayers. We pay income taxes whenever we engage in labor, right? Whenever we receive wages or some other compensation for our work. We also pay sales taxes in most localities, state and local taxes, whenever there's a sale of goods or services. And if we own vehicles in jurisdictions that impose that personal property, car slash vehicle tax, we're going to pay those. If you're a homeowner, you're also going to be paying those. If you have a mortgage in your home, then generally the mortgage company pays for that. Today, we're not really going to be discussing property or car taxes or even sales taxes, even though that could become relevant as part of your income tax journey. But mostly, we're just going to focus on the income tax that you pay to the federal government through the IRS, or in our case, through Virginia taxation, where we pay our state income taxes. You should know that there's different types of taxes, right? There is the pure tax that we pay to the government to help with the budget for roads, for bridges, for schools. There is payroll taxes, which is really something that we're paying into government funds, but it is for ourselves. Social Security taxes represent 6.2% of your income, and Medicare 1.45% of your income. That is what you would pay if you're an employee, and your employer would match that. Please understand that if you are an independent contractor, you are your own employer, you are your own boss, and so those numbers are going to double. You are going to have to pay into the Social Security Fund 12.4% of your income to save for your retirement. And into the Medicare fund, you would be depositing 2.9% of your income for healthcare once you retire. Again, you're also going to be paying to Virginia. The maximum rate in Virginia is 5.75%. And this, like the federal income tax, helps the government budget for schools, first responders, and other public services. It is important that we realize that all income is taxable. And this is important here because I need to clarify something I said before. Generally, we think of income tax as something that has to do with our work, with wages or salaries. If we own our own business, then we think of it as business profits. But any amount that you receive are likely going to be defined as income. So you think it's just a hobby. I sell things that I make because I get pleasure out of it. Well, if you are indeed covering more than your costs with whatever you're charging, then it may be a hobby. You may get pleasure from it, but you have income. And I will say that the problem with declaring that something is hobby income is that if it's not a business, you can't really deduct your business costs. So you really have to rethink that approach. I help a lot of clients rethink that and understand that you're better off claiming it's a side business. Um, if you own your home and rent space in your home, whether it's for storage, right? You're renting part of the garage because you're not using it. That rent is income to you. It could also be that you're renting a whole home. Also investments. That's really not, unless you're a day trader, it's really not going to be a job for you. Um, it's going to be, however, income that you receive because your bank pays you interest or because you're receiving dividends or selling stock that you own. Gambling winnings. Unless you can offset all of those winnings with losses, that is income as well. Now, there are things that are exempted. You are receiving, let's say, child support payments for the children you share with your former spouse or partner. That's not truly income. Alimony is not considered income. If you're receiving welfare payments, if you get money because it's your birthday or someone likes you because you're so pretty, if that's a gift, then it's not truly income. But again, just consider that most things, unless they're exempted somehow, they are going to be considered income and you have to report them and perhaps pay taxes on them. Very well. We talk a lot about deductions, but what are deductions, right? In the tax world, deductions are amounts that you take out of the calculation of your income. So when you calculate what your income is, later on, you're going to apply a percentage to that number. But what deductions do is they bring down that number down so that you pay a percentage of a smaller number. When we think about that, it's easy to think about expenses from a trade or business. So you're going to be spending money on the cost of buying eggs and flour because you're a baker. You deduct those expenses and perhaps as well what you spend in electricity from your bakery. Whatever the costs are of running the business, you're going to deduct those from the money that you made throughout the year. And then we would apply that percent to what's left. There's also, for example, contributions to retirement accounts like traditional IRAs, to health savings accounts. For many of us, for many years, I was deducting student loan interest. I am already paid for, but that was very important to me that I could deduct that. Educators' expenses. Oftentimes, our teachers have to spend some of their hard and earned money to pay for supplies, and there is a deduction. The government recognizes that a certain amount of money, unfortunately, may have to be spent by teachers, and so there's a limit, but there's certainly an amount that you can deduct, at least on the federal side. Also, losses from the sale of property. That's important. It brings down whatever your income was for the year. Here's a little bit more detail. Schedule C, if you've ever done your taxes before, has a host of categories of things that you can deduct. So transportation costs, cell phone and other utilities, like I said, electricity. If you have a location where you have your office, you're going to have to pay for water usage, right? So all of those things, materials and office supplies, insurance, and what that means is not included in mileage. So it can be insurance because you're an attorney and you want to have malpractice insurance, or you're a doctor. You also might want to have just premises insurance in case someone slips and falls in your office. And of course, rent, things like that. So it's fairly obvious when you look at Schedule C. You should consult with your accountant and let them know, like, do you have receipts to support these expenses? Are they business expenses? Very well. So something really important, and I would imagine if you're here, you want to know, do you have the obligation to file federal tax returns? And I want you to listen carefully. It's a lot of detail, but understand that we're talking about federal tax returns. A lot of the obligations are going to have to do with how much you make, how much income you have. It may be different on the Virginia side. So we're going to stick around to one of the last slides because the obligations are a little different. If you are self-employed, if you are that independent contractor that has to pay the employee and the employer portion of Social Security and Medicare, you have the obligation to file your taxes as soon as you have earned $401. That is an arbitrary number, but it is the number. And so if you know that you have done that, and maybe you don't think of yourself as an entrepreneur and a business owner, you're just someone who mows the lawn and charges the neighbors. Well, if you are that someone and you have made $401, you need to report that. You may also have, regardless of income, to file a federal tax return if you obtain your healthcare insurance through the marketplace. This is the marketplace that was set up by the Patient Protection and Affordable Care Act, which many lovingly or disparagingly refer to as Obamacare. So if you are one of those people, you're going to receive a 1095A. That is going to break down the premiums that you have paid or receive through these subsidies, and that has to be reconciled in your federal tax return, so you have to file. Now, if you're not someone who's self-employed and earns $401, or someone who gets their health care through the Obamacare marketplace, then there's different levels of income that might trigger your obligation. If you're married, filing separately, your obligation to file snaps into place as soon as you have earned $5. Married filing separately is a disfavored taxpayer category, so the government keeps a closer track of these, and they really want to know what are they want to compare, right? They want to have someone who is married filing separately and someone on the other side as well. You're going to have to identify each other through Social Security or ITIN numbers, and they're going to be reconciling those tax returns. Otherwise, you can think of yourself as single. If you are single, don't have any dependents. You can think of yourself as the head of household if you are single, but have dependents, whether those are children or perhaps adults. It could be your parents, it could be a disabled sibling, for example. That would make you a head of household. You can also think of yourself and file as married filing jointly, or as a surviving spouse, who is someone who, until recently, 2 years prior, for example, had been married but lost their spouse. Depending upon your age, 65 or older, or under 65, there's different income limits. So for example, if you're single and you've earned $15,750 and you're under 65, then you immediately have the obligation to file. It doesn't mean you're going to have to pay anything because we still have to think about credits, for example, but you definitely have to report and file. It may also be a good idea for you to file because if it ends up that you don't have an obligation to pay, you may be getting some of that tax you paid into the fund back. Or you may qualify for a refundable credit, and we'll talk about that, and you get money in your pocket. This happens with, for example, the earned income tax credit. Very well. As I said, married filing separately is disfavored. And what that means is that there's going to be certain credits and certain tax advantages that you do not qualify for because you filed as married filing separately. It's extremely disfavored. So you really need to think about how to transition into head of household or single, or otherwise figure out like a better tax position for yourself. Again, I mentioned you might want to file because there may be a credit that you qualify for that can put money in your pocket, but also, and I see this a lot with individuals who are retired on just on Social Security, you should consider still filing, even if you don't have taxable income, because it protects your identity. No one can file using your Social Security number, and therefore no one can commit tax fraud. This is one of the problems. It's not that people use your Social Security number to work and then pay the taxes responsibly. They may be leaving you with a bill for taxes that shouldn't be attributable to you. But if you use it, especially if you have your own IP PIN, your identity protection number, then no one can use your Social Security. Okay, so we talk about income, but how do we get to income? As I mentioned, you might be an employee, right? You are going to be someone that works for another that receives benefits, and for tax purposes, that is going to have certain amounts withheld from every paycheck so that those can go again into the Social Security Fund, Medicare, or into simply the IRS income payments. The way the employer figures out how much to withhold is because they provide you with a W-4, which I'm going to show you later. Based on that, they're going to prepare a W-2. And a W-2, no, I can't show you mine. It has my Social Security number, but it's going to have whatever amounts you paid, whatever taxes were withheld, both for the state and for the federal. It's really important you take that to your accountant, to your free tax preparer at Avita Center or AARP, because that's something that you should receive and the IRS will have received. If for some reason your employer has not provided you a W-2, because you're running behind, because your accountant is sick, because they're irresponsible, you can nevertheless look at all of your pay stubs and then file a form 4852 that it's a substitute form for W-2. It allows the IRS to calculate your obligations, see how much you paid, how much you owe, and it also alerts them to contact the employer to see why they're not fulfilling their obligations. As I said, all of the information there, withholdings, whatever goes to extra monies that you might put away on an IRA or a 403, 401k, 403, those are going to come from the W-4 that you fill out. That is going to tell your employer, the human resources officer, whether you're single, married, filing jointly, etc., how many dependents you have, and then you can even adjust a little further to take out a little more, to take out a little less. We never advise people to try to take less unless every time you file your taxes, you see that you have this huge refund. And then throughout the year, you're struggling because you really have to budget so tightly to make ends meet. So that's one indication that perhaps you want to withhold less, but generally it's really smart to withhold as much as you can. Make sure that your taxes are paid in full or close to full, because if it ends up that you withheld too little, and you end up, for example, owing $1,000, more than $1,000 when you file your taxes, there can be a penalty assessed because you're not being responsible in monitoring your tax obligations. Now, as I said, there are those who are not employees, and you have to remember you're a 1099 worker. you are probably going to receive a 1099 NEC, non-employee compensation, or miscellaneous. There could be other 1099s, 1099K, for example, you receive all of your payments through electronic platforms like Zelle, but it's going to be a 1099. Now, remember, that is not going to show that any money was withheld, because if taxes were being withheld, you would be an employee. But it means that you are going to have to pay self-employment taxes. You're going to be responsible for 12.4% of your income as Social Security payments and Medicare taxes. You have to report cash earnings. It doesn't matter. Again, it is your responsibility to report your earnings. Don't forget that how much you earn throughout your career, throughout your professional life, is going to influence the retirement that you get, the Social Security payments that you get at the end of your professional career. So it's always in your best interest to be honest and to secure a more stable future. Remember that you can deduct ordinary and necessary business expenses. I should have said that before. If you have a bakery, it is certainly ordinary and necessary to, say, have a delivery van, right? Maybe you are delivering your products to Mom's Organic Market or Whole Foods. And a delivery van would be a normal expense. A Ferrari, a sports car, maybe even a motorcycle might not be ordinary and necessary, right? It has to be something that is related, directly related to creating profits, to creating income. Something else that you need to understand is that because you are expected to act as your own employer and pay that part of Social Security and Medicare, you are going to be expected to make regular, periodic, estimated payments. And let's talk about that now. So we don't think about it that way, but all those withholdings that employees get taken out are estimated payments, right? As your own employer, they don't expect you to do it for every paycheck that you get, for every payment that you get from the contractor. But they do expect you to think about how much you paid in taxes the year prior, take that number, divide it into 4, and then make quarterly payments with the idea that you probably will make at least about as much this year as you did last year. It's possible that you will make more. Hopefully you do, because your business prospers. But you have to at least make those 4 payments to be in tax compliance. The limit is if you earn more than $1,001. But math is hard, so I chose $2,000 here as an example because it's easier to break up. So if you make $2,000, if you paid $2,000 last year in taxes, then think about structuring your 4 payments as $500 payments. And you would make your first quarterly payment on April 15th. Perhaps you could think of it as going along with filing of your taxes, but hopefully you're not waiting until the last minute to file your taxes. So April 15th, June 15th, September 15th, and then January 15th. So you should have already made your 4th quarterly payment for the last year if you are an independent contractor. Okay, so as we said, deductions are an amount that you subtract, that you take out of your income to get to taxable income, to get to that amount to which the tax rate gets applied. There are, as we said, the deductions above the line, which is what we call the student loan interest, the business costs. But there's also called standard deduction and something called itemized deductions. Most taxpayers, at least most taxpayers that come to Legal Services of Northern Virginia, but certainly in general, take the standard deduction, which is a bulk amount that gets subtracted from the income made throughout the year. You might want to itemize if you have certain special expenses that we're going to talk about. So, if you are one of those people who prefers the standard deduction because you don't have enough, let's say, medical expenses, or your mortgage doesn't carry an interest high enough to make it worth deducting instead, you are going to be in these categories. Single or married filing separately, these individuals are going to get the equivalent of $15,750 as the standard deduction. If you've been paying attention, and I hope you have, that number is the same as the number that triggered the single taxpayer's obligation to file. So that means you have to file, but you're not going to pay. Those first $15,750 are going to be protected. And then there's different numbers for the other categories. Now, remember, we talked about before that taxpayers that are 65 or older have some special provisions. In this case, there is one additional deduction amount that we have always had, and it's adjusted for inflation year to year. So if you're 65 and older, you're going to have an additional deduction of $2,000 if you're single, or $1,600, $1,600 per taxpayer if you're married filing jointly, right? In addition, new this year, we have the $16,000 per taxpayer deduction for those who are 65 and have a valid Social Security number. So if you have an ITIN number, unfortunately, you cannot get this additional $6,000 deduction. I say valid because some individuals have Social Security numbers as part of their applications for immigration status as refugees or asylees, but those might not be valid for work. They're going to be valid. They were assigned to you by the government, but the issue is being valid for specific types of work. In any event, there's another additional deduction. If the taxpayer is blind, then they qualify for a $1,600 deduction. Now, let's think of itemized. There's many of them, but these are most common. Medical expenses. This is a special category because it's not dollar for dollar. What's going to be itemized, possibly, is that amount of medical expenses that is above 7.5% of your adjusted gross income. Let's make numbers easy. So let's imagine that your adjusted gross income is $100. And let's say that you spent $10 in medical expenses. Well, 7.5, so $7.50 is that 7.5% of 100. You are going to be able to deduct not the full 10, but that 250, right? Above the 7.5 and up to that $10 mark. For mortgage interest, you can now deduct up to $750,000 in mortgage interest. I don't believe that we would see such a high number amongst the individuals we can serve at Legal Services of Northern Virginia. It certainly sounds like it's quite an extravagant property, but it's possible. Of course, if you're married filing a single, the disfavored category, the number is going to be less. New this year, if you're a person that itemizes, right, and you pay a significant amount in SALT, state and local taxes, well, now you're in luck. so long as you're not married filing separately, you can deduct up to $40,000 in these SALT taxes that you paid. It's important you can itemize your gambling losses. You can offset your gambling winnings with the losses if you itemize, but only remember up to gambling winnings. Let's say you won, I like round numbers, you won $10, you lost 15. Well, you're only going to get to itemize and deduct $10, right? If you had won 15 and lost 15, then it zeroes out. And let's say if you had won 10 and lost 5, then you only have to recognize that that 5,000. In addition, fairly common, and I love that about this region, we have a lot of taxpayers that engage in charitable giving, and you can certainly deduct your charitable donations, cash or property, when you itemize. Starting next year, there's going to be a certain amount of charitable donations that you can deduct even if you don't itemize. But that's not a now concern, that's a next year concern. Okay, so not all the new things for this tax season are great. We have lost some of the itemized deductions that we had before. So no one can now itemize and deduct unreimbursed employee expenses, tax prep fees, investment advisory fees, safe deposit box fees, job search expenses, and certain legal fees. Again, you should consult with the person that is helping you prepare your tax return to make sure that you know what to deduct and what not. Okay, so everybody in the service industry is extremely excited about this no tax on tips. You do not have to itemize for this. So in this way, it acts like an above the line deduction. Now, you have to have a valid social security number. If you're working with an ITIN number, this is not going to benefit you. And you have to work in one of these 8 industries that I have listed here. I will tell you, the guidance from the IRS is very specific. There are certain professions within these industries, but I can't list them all today. So just to give you a sense, these are professions that traditionally receive tips. We have beverage and food services. So think about your waiters, your bartenders. Think about hospitality. So the individuals that help you carry the suitcases here and there. There's going to be tutors and nannies. Recreation, you take a tour, you travel with some sort of business that's going to guide you in the parks. Let's say you go to Yellowstone, right? You with a tour, you're going to tip your guide. That's probably someone who can deduct up to $25,000 in tips. So whatever you make above that is not going to be deductible. You're going to have to recognize it as part of your income. Now let's remember 3 other things that are necessary. The tip has to be voluntarily given. So think about when you go to a restaurant with a whole bunch of friends and the menu or somewhere on the wall, it says that for parties of 6 or 8 or whatever the number, the tip will be mandatory. So already you are not going to be able to deduct whatever tip you get from that table. In addition, it has to be determined by the person tipping, and that's important because I have seen on the receipts, on the menus, parties of 8 or more will be assessed a 15% tax. Not determined by me, who's supposed to be tipping, so not deductible by you. And again, there can be no negative consequences to individuals if they decide not to tip. I certainly hope that there's never a negative consequence for something like that. But these are really important. Another new thing is no tax on overtime. This is time limited. It's going to apply to the taxes we're filing now for 2025 up through the taxes we file for year 2028. Again, you have to have a valid Social Security number. And you have to have received qualified overtime compensation. This is a term that's included in the Fair Labor Standards Act. It is something that has to be reported separately on Form W-2. So if everything is a bulk, right, if it's just one number reported on the W-2 and nothing reported on the special square, and identified as qualified overtime compensation, then you can't on your own decide that you're going to apply this deduction to some of the money. Something very important, the deduction doesn't apply to all your overtime work. When we think of overtime work, we generally think of time and a half as payment or double time, right? So think about your regular rate of pay, $10. If you were going to work 1 hour of overtime, you would get 15 if you're working time and a half. So time is 10, half is 5. Those $5 are the dollars that you can deduct that are not going to be taxable. There is a maximum. If for some reason you are being worked ragged on overtime, and you are accumulating a lot of income through that, just know that as a single taxpayer, you cannot deduct any more than $12,500, $25,000 for married filing jointly. Also know that this deduction phases out for higher income individuals. So there is a lot of nuance. Make sure that you're going to someone that is certified, that has studied this, and that can help you. I wouldn't venture doing this on my own, especially the first year, right? Get good guidance. Very well. Another time-limited deduction that many people are interested about is the deduction on new car loan interest. So how does this work? You can deduct up to $10,000 a year in interest if you have a qualifying, and we'll talk about the qualifyingness, a qualifying new car loan. So, the phrase says it. It has to be a new car. If you bought a used car, you already cannot deduct interest. The car must have been assembled, at least the final assembly, must have occurred in the United States. This is important. The car has to be for personal use. If you're also using this car as your main vehicle for business, you are not going to be able necessarily to deduct this. I'm thinking about some clients, right, that they have so much business mileage on their car that it no longer qualifies as personal use when they go, for example, to the county to claim an exemption from personal property taxes. So think about this. It has to be a car that perhaps occasionally you use it to make a delivery here and there, but it has to be a personal use car. Now, the loan for this car must have been generated after December 31st, 2024. So starting January 1st, 2025, it has to be secured with a lien on the car. The car has to be a car. It has to weigh less than 14,000 pounds. I have no idea how much a car can weigh up to, but I would imagine that the bigger, the heavier the car, the less likely it is that it has a true personal use. I'm thinking about these enormous pickup trucks I see on the street that clearly are being used for construction, for agriculture. This deduction, like others, is also going to phase out if you are one of those higher income earners. Okay, so we talked about you have your income. You're going to apply deductions. Some are going to be above the line. Some are going to be different. It's a standard, it's itemized. Great. We arrived to your taxable income. And to this income, we apply that tax rate, right? That percent to determine what you're going to pay. From that total that's been set through the machines and multiplied, you might be able to subtract some amounts from that through credits. Okay, so credits can be refundable, which means that you can get a check deposited into your account whether or not you owe money to the IRS. And some are non-refundable, meaning that they can get your bill to zero, but then you don't get any money left over from the credit. So here's a good way to think about it. Tax owed, right? $1,500. One column says refundable, one column says non-refundable. If we have a refundable tax credit, you owe it, like I said, $1,500. The credit is $2,000. You apply the $2,000 to what you owe. There's going to be $500 left over, and you can get that deposited into your account. But if it's non-refundable, again, once it gets to zero, you cannot receive anything, but you don't owe anything. So it's not that bad. Now, most of the popular, well-known credits are the earned income tax credit and the child tax credit. And I may be saying this because that's what's true for our clients. These are going to depend in terms of amount based on your filing status and based on the number of dependents that you can claim. You can get the EITC, the earned income tax credit, even if you don't have any dependents, but if you do, it's going to be a little higher. So, in order to receive those, for example, you need to have a qualifying dependent. There's a lot of examinations and audits regarding children, qualifying children, and sometimes qualifying relatives. It's important that a child has to live with the taxpayer for more than half the year. So half the year plus a day, right? The child cannot be paying 50% of its own support. And it must be a child that is under the age of 19 in some cases. In others, it's a different age, but it's under an established age or otherwise be permanently and totally disabled or be a student. So it's important that as we go through these credits, you think about that when you are sitting with your accountant or when you are going through preparing your taxes on one of these software platforms. It calculates these things. It's going to ask you questions. It's going to know the age, right, and social security number of your children. It will ask you if the child, is the child, let's say, 23? Well, is he or she a full-time student? You're going to click yes, and then it's going to calculate that for you. You don't have to do any of this math. If it's a qualifying relative, it's going to have different requirements. And in this case, it's going to require that the gross income of that qualifying relative be less than $4,700. So it's not going to look at the percentage of self-support, but it's going to look at some other numbers. Now, let's talk about these three. I should have also put a little star next to child and dependent care credit because there are some new things there. But let's take a look at the earned income tax credit. It is not a new credit, but it has some new features. First of all, it's really important. Parent and child must have social security numbers. And by parent here, it's taxpayer parent. So a child could have one parent with a social security, and one parent with an ITIN number. As long as there is a parent in the household with that Social Security number, that is going to be one of the qualifications. If the household is ruptured so that you actually have two households, it is only the parent that has the Social Security number that can claim that child as a dependent for purposes of earned income tax credit, so long as other limitations are met, right? As I said, you don't have to have a qualifying child for the EITC. It says here you can get $649. I don't want anybody to think that they will get that. Whatever number, whatever credit amount you get is really going to hinge on your own income. The more you earn, the less earned income tax credit you will qualify for. The more dependents you have, the higher the amount is likely to be. Now, in terms of income, there are cutoffs, just like for some of the deductions, there were cutoffs if you had certain adjusted gross incomes. In this case, there's going to be cutoffs both for investment income. So if you have Bitcoin or you have your Robinhood account and you have stocks, just make sure that you have less than $11,950 earned as investment income. And in terms of labor income, there's going to be different numbers, whether you're married filing jointly, single, head of household, etc. Now, again, I have to insist, the taxpayer, right, the custodial parent, the person with whom the child lives for at least, well, for half the year plus a day, right, for more than half of the year, has to have that Social Security number, as does the child. If the child is permanently disabled, it doesn't matter the age. If the child is 19 or older, but in school, they might qualify as a dependent for the EITC until they reach 24 years of age. When I say child, it has to be a child that has a legal connection to you. It could be your biological child, an adopted child, and a formally fostered child. It can't be someone that you just took in and are supporting out of the goodness of your heart. There has to be some legal connection that you can prove in order to qualify for this credit. As I said, the married filing separately taxpayer status is always disfavored. So there's going to be some additional requirements for those individuals. If you're legally separated, because there's a state law, a state order, written order that establishes you are indeed legally separated, then you might be able to claim a qualifying child. Otherwise, this is not going to be something that is truly available to you unless you can show that you've been living apart for the last 6 months of the taxable year. And it has to be the full 6 months. If you separated on July 5th, that's already not the full last 6 months. Again, these are the top amounts. So let's look at the bottom. If you have 3 or more qualifying children, and you have the lowest income on these charts that the IRS prepares, then you are going to receive the maximum credit of $8,046. But that's going to vary, again, depending upon your income and the number of children. There's also the child tax credit. As I said, for these credits, the age of the qualifying child is going to be important. For this one, the child has to be 16 or under on the last day of the year. So if the child is 17 on the last day of the year, you're not going to qualify. This has both a refundable and a non-refundable portion. So the total, the maximum per child, is going to be $2,200. This part is divided, this amount is divided into the refundable part, which is $1,700, and the rest would be non-refundable. For the non-refundable part, they can take your tax bill to zero. You don't need to have any income. So even if you didn't work and technically, don't really have obligations, maybe you just have some investment income, maybe you have some form of income, but there's no limit to it, right? You don't have to have a minimum income. That's fine. It can take you to zero. But generally, if you don't have income, I'm not really sure why you would have a tax bill. The part that is refundable is going to require that you earn at least $2,500 during the year. As long as you earn at least that, you will get the $1,700 per qualifying child. Again, please remember, we need Social Security numbers for this. Let's see. There's also going to be those other requirements of residency, of support. Child independent care credit. This is not refundable. This is intended for individuals who are working or looking for work and who need to pay for care of their minor children or perhaps of a physically or mentally incapable adult, so that they can indeed look for work or work. It's not going to reimburse you for all of your costs, but this year the eligible costs can be up to 50% of what you spend, so long as that 50% is not more than $3,000. So let's say that you spent $6,000 in the care of your qualifying child, 12 years or younger. If you spent $6,000, maybe you can get 50% of the eligible costs. It's going to depend on your income. It's also going to depend on your ability to provide corroborating documentation that someone indeed took care of your child. In general, you can have a letter, a note in the letterhead from the daycare center. You want them to have some form of employer identification number corroborating that they indeed provided care for your child or an adult in your care that requires. Again, depending upon your adjusted gross income, you are going to be eligible for a reimbursement of 50% or perhaps only 20%, depending where you fall on this chart. It's really important, as I said, you want some corroboration. Perhaps it isn't a daycare center, perhaps it's a nanny, and that's okay. But it cannot be that you're paying your other children to take care of the minor child. It has to be a third party. Again, let's remember that if we received a 1095-A because we get our Obamacare healthcare coverage, we need to bring that to our accountants, make sure that is reconciled. If you have children who are studying, right, in college, in a technical school, look for Form 1098-T. The T is for tuition. This is something that is generally going to be provided to the student, not to you as a parent, even though you're paying, perhaps. They have to go into their portal, look for the tax statements. And this is something that is going to help you access certain American Opportunity credits or lifetime credits. And it's rather important for you to enjoy those credits. As I said, you must file in Virginia under standards different from the federal. So for single individuals, they don't need to file a tax return unless they have earned $15,750, but you would still have to file a state return if you earned at least 11,950. And the number doubles for those married filing jointly. There are also different numbers applied for standard deduction in Virginia. The great news, Virginia also has an EITC, an earned income tax credit. And this year, the percent has been adjusted and increased. So let me explain. Generally, the way the EITC is calculated in Virginia is as a percentage of whatever you received from the IRS in the similar credit. It used to be 15%. This year is going to be 20%. And remember to access all of these credits, to take advantage of deductions, to prevent yourself from being assessed penalties for late filing or payment. Please file by April 15th, 2026. If you need an extension, you need to request that before the deadline. The IRS can extend the filing deadline up to October 15th. If you end up owing anything, you're going to pay interests. But at least you will avoid a penalty if you ask for permission, right? For state taxes, you have until May 1st, 2026. I strongly encourage you to visit an AARP Tax Aid Center or a VITA Center to get your taxes done. These are individuals, volunteers that have been trained and certified through a very stringent, demanding, thorough process. I volunteer as in part of the AARP tax aid program, and we take many classes, we take many tests, we are well prepared. My name is Vilevska Watkins, and I am a staff attorney and qualified tax expert at Legal Services of Northern Virginia. We are not accountants. We cannot file your taxes for you. But if you get a notice from the IRS saying that you miscalculated your taxes or they want you to prove that your children are yours, then you can call us and we might be able to help you, to provide you some advice. And we'll see how else we can help. We can refer you. Perhaps we can put you in contact with the Taxpayer Advocate Service. And now I believe that I am done. I'm going to be taking questions, but I want to stop recording before I do that. Thank you for listening.